At the end of November 2008, a firm on 3rd Avenue in Manhattan held roughly 4,900 client accounts. Those accounts showed a combined balance of $64.8 billion. The real number was zero. Not diminished, not mismanaged. Zero. There were no investments. There had been no investments for decades. Those statements were produced by a computer program written for the specific purpose of inventing them. When he finally confessed, Bernard Madoff told the court the fraud had begun in the early 1990s. Prosecutors didn't accept that. Evidence later presented at the trial of 5 of his employees indicated it had been running since at least the early 1970s. Meaning that by the time it collapsed, the scheme was potentially older than most of the people invested in it. But the strange part isn't that he got away with it for that long. It's that a man in Boston did the math in about 5 minutes and told the government 3 times.
The SEC continues to roar like a mouse and bite like a flea. I gift-wrapped and delivered the largest Ponzi scheme in history to them, and somehow they couldn't be bothered to conduct a thorough and proper investigation because they were too busy on matters of higher priority. If a $50 billion Ponzi scheme doesn't make the SEC's priority list, then I want to know who sets their priorities.
Bernard Madoff was not operating from the shadows. That's the first thing to understand, and it's the thing that makes everything after it possible. He founded his firm in 1960. It became one of the largest market makers on Wall Street, a genuinely significant business that helped pioneer the electronic trading the modern market runs on. He served as chairman of NASDAQ in 1990, 1991, and again in 1993. He was, by any reasonable measure, the establishment. Alongside that legitimate trading operation sat a second business, an investment advisory arm. Quieter, smaller apparently, and essentially impossible to get into. What it offered was a return of roughly 10 to 12% a year. Not spectacular. Spectacular would have attracted attention. What made it remarkable was the consistency. If you charted those returns, the line climbed at almost precisely the same angle year after year. Through the crash of 1987, through the dot-com collapse, through September 11th, the line barely noticed. That line is the whole story. It's why thousands of people handed him everything they had, and it is the exact thing that would eventually prove he was lying. By the end of this, you'll know the one question that could have exposed this entire scheme in a single afternoon. It's a question you can ask about your own money in roughly 30 seconds. Almost nobody asks it. And, as you'll see, that includes the people whose actual job it was. Because access was restricted, the exclusivity did the selling for him. You didn't approach Madoff, you waited to be invited. And people who are grateful to be let in don't tend to ask difficult questions. Officially, the strategy was called a split strike conversion. Buy a basket of large cap stocks, then use options to cap the losses and cap the gains, trading away your best months in exchange for never having a catastrophic one. It's a real strategy. It exists. It is not, on its face, absurd. The problem is that none of it happened. According to the SEC's case and his own guilty plea, Madoff's employee Frank DePascali supervised the creation of computer programs that generated trade confirmations after the fact. Staff pulled real historical price and volume data, selected favorable entry points that had already happened, and printed statements showing trades that were never placed. Millions of pages of them, mailed out year after year. Madoff would specify the returns he wanted. DePascali later admitted to being directed to produce profits in the range of 10 to 17%, and the paperwork was built backwards to match. At one point, Madoff became concerned that showing a profit every single month looked suspicious. so he had Di Pasquale insert occasional losing trades. Fictional losses added to fictional gains to make the fiction look more like reality. Underneath the paperwork, the actual operation was the oldest one there is. Money from new investors was used to pay withdrawals to old investors. Nothing was invested, nothing grew. The scheme's only real input was more people, which means it had one structural requirement. It could never stop expanding. There was one more thing holding it up. Every year, the firm's books were signed off by an outside auditor, a firm called Freeling and Horowitz, based in New City, New York. 3 people worked there. One was a secretary, one partner was in his 70s and living in Florida. An operation claiming to manage tens of billions of dollars was audited by a firm you could fit inside a 2-car garage. For years, nobody with the authority to look ever looked. Then, in 1999, a portfolio manager in Boston was given Madoff's numbers and told to replicate them. Harry Markopoulos was a quantitative analyst at a firm called Rampart Investment Management. His employer wanted a product that could compete with Madoff's, and Markopoulos was given the return history and asked to reverse engineer it. He later said it took him about 5 minutes to know the numbers were fake, and roughly 4 hours to prove it. The problems were not subtle. Over the period Markopoulos examined, Madoff reported 3 losing months. The market over that same stretch had 26. Madoff's worst month was a decline of 1.44%. The market's worst was a fall of more than 14%. But the finding that ended the argument had nothing to do with performance. The strategy Madoff described required trading options on the S&P 100. Markopoulos worked out how many contracts would be needed to support the amount of money Madoff claimed to manage. The number was larger than the entire volume of that options market. Every contract traded by every participant, and it still wasn't enough. He wasn't outperforming the market, he was reporting trades that could not physically fit inside it. In May of 2000, Markopoulos submitted an 8-page analysis to the SEC's Boston office. Nothing happened. In March of 2001, he submitted a second, more detailed version. Nothing happened. In 2005, he submitted a document titled "The World's Largest Hedge Fund is a Fraud." It listed 29 separate red flags. And here is the part that is genuinely difficult to sit with. It isn't that nobody noticed. In 2009, the SEC's own Inspector General published a 457-page report into how the agency had missed it. That report found the SEC had received 6 substantive complaints about Madoff over 16 years and had opened multiple examinations and investigations, none of which uncovered the fraud. The report identified one failure as the most serious. Investigators, in its words, never verified Madoff's purported trading with any independent third party. Had they compared his customer statements against the records of the Central Clearinghouse, they would have realized immediately that he was not trading anywhere near the volume the statements claimed. Madoff himself was interviewed for that report. He described being questioned by the SEC in 2006 and handing over his account number at the clearinghouse, the one document that would have exposed everything. In his words, he thought it was the end. Game over. Monday morning they would call and it would be finished. Nobody called. So the money kept arriving, the statements kept going out, the line kept climbing at the same impossible angle. And then, in 2008, the entire financial world needed its cash back at once. A Ponzi scheme becomes insolvent when withdrawal demands exceed incoming capital. In the autumn of 2008, that is precisely what the world did. Investors across every asset class were selling whatever they could to raise cash. Madoff's clients were no different. By early December, requests to withdraw money had reached approximately $7 billion. He did not have it. He had never had it. And this is where that beautiful, consistent line finally does its work. Because the reason Markopoulos identified the fraud in 5 minutes is the same reason thousands of investors trusted it for decades. They looked at a line with no risk in it and saw safety. He looked at the same line and saw the one thing markets never produce. The smoothness wasn't evidence of genius, it was the fingerprint. On the 10th of December 2008, Madoff called his 2 sons into his office. Mark and Andrew both worked at the firm on the legitimate trading side of the business. He told them the investment advisory arm was, in his own words, one big lie. They contacted a lawyer that evening. The lawyer contacted the authorities. The following morning, December 11th, federal agents arrived at his apartment. One of them asked whether there was an innocent explanation. According to the FBI's criminal complaint, Madoff answered, "There is no innocent explanation." The scheme was over. The money was a different problem entirely, because the $64.8 billion on those statements had never existed. That figure was the total of the balances Madoff had invented. More than 2/3 of it was fabricated profit numbers typed onto paper. The money investors had actually handed over, the real principal, was later established at approximately $17.3 billion, which is a smaller number and a worse one. $17 billion of actual savings left by actual people. Charitable foundations closed permanently. University endowments took losses. Retirees in their 80s discovered that the account they had been reading for 20 years described nothing. Some investors had withdrawn more than they put in over the years and were then sued by the court-appointed trustee to return it, because that money had come from other victims. Frank DePascali pleaded guilty in August 2009 to 10 counts, including securities fraud and money laundering. David Freeling, the auditor, was charged with securities fraud, aiding and abetting investment advisor fraud, and filing false audit reports. He pleaded guilty later that year, admitting he had rubber-stamped Madoff's filings rather than actually reviewing them. On the 11th of December 2010, 2 years to the day after the arrest, Madoff's elder son Mark died by suicide. His attorney described him as an innocent victim of his father's crime. On the 12th of March 2009, Bernard Madoff pleaded guilty to 11 federal charges, including securities fraud, wire fraud, mail fraud, perjury, and money laundering. He entered no plea deal and named no accomplices. In June of that year, he was sentenced to 150 years in federal prison, the maximum available, and a number the judge described as symbolic. He died in custody in April 2021 at the age of 82. The outcomes for those around him varied enormously. Freeling, who cooperated extensively with prosecutors and testified against 5 of Madoff's employees, received no prison sentence at all. 1 year of home detention, 1 year of supervised release, and the forfeiture of more than $3 million and his properties. The recovery effort, meanwhile, has been more successful than almost anyone expected. The court-appointed trustee, Irving Picard, has recovered more than $14 billion of that $17.3 billion in lost principal, over 80%, largely by suing investors and feeder funds who had taken out more than they put in. That recovery took more than a decade. Many of the people it was meant to make whole did not live to see it. So the question. In a legitimate arrangement, 3 jobs are held by 3 different parties. Someone manages the money, someone else physically holds it, an independent custodian, and someone else again checks the books. Madoff held all three. He managed the funds, his own firm held the assets, generated the statements, and he selected the auditor, the three-person office with the secretary and the partner in Florida. There was no independent party anywhere in the chain. Every piece of evidence that the money existed came from the man who had taken it. Which raises a critical question. Who actually holds my money? And can I confirm the balance with them directly without going through the person managing it? That is 30 seconds of work. And it is worth remembering that this is not a clever question. It's the same question the regulator failed to ask for 16 years. One phone call to an independent third party, which Madoff was expecting, that never came. The second thing this leaves you with is harder because it runs against instinct. We're trained to read steady returns as safety. In markets, steady is the anomaly. Risk and return are attached to each other. When the risk vanishes from a return, but the return remains, it hasn't been eliminated, it's been hidden, or it was never there. Consistency that good isn't a track record, it's a claim. And a claim is only worth as much as the independent party who can verify it. Madoff's scheme is the largest of its kind ever run, but the machinery underneath it wasn't sophisticated. It was the same structure operating in crypto schemes and investment clubs right now, at a smaller scale with better branding. Next, we break down exactly how that machinery works, why every Ponzi scheme is mathematically guaranteed to collapse, and roughly how long each one has before it does. If this was worth your time, please leave a like. It puts the story in front of somebody who is, at this moment, being offered a return that sounds pleasantly consistent. Please subscribe, and the next case file will find you on its own. I'm James. Thank you for listening.